I'll tell you what I used to do at a private equity firm. We would look for middle market companies that had about $10 million in EBITDA. That's, traditionally what we call earnings before taxes and interest and depreciation. We would look for companies that were in the business service industry because we know that they had a high cash flow conversion and they were not as capital intensive. Once we found a good company that fit the criteria, we would see how much leverage so we could put as little equity as possible. And what that does is the less amount of money you put in, obviously the higher your return on equity is because you're using other people's money to buy the company. In this case is the bank. And then we would push the company to the limit to see how much debt we could put on it and how quickly we could get our cash back and how quickly we could pay off the bank and then try to grow the company to sell the company for a much higher multiple. This notion that private equity buys companies to bankrupt them is not right. It's internet baloney. Private equity is not looking to bankrupt companies. There are certain private equity groups that they're essentially what we call vulture capital. They are looking to take companies, strip them down to the bones, and then sell off the assets and try to make as much money as possible. But the intention is never to bankrupt the company, because if you bankrupt a company, then you get a bad rap as a private equity firm. And the street is this small. Everybody knows everybody. And the word gets out, lenders won't lend to you anymore. And you're only as good as the last deal that you did.